classmates, welcome to International Microeconomics. Today we will learn Section 6 in Chapter 10, the Eurozone in Crisis, 2008-13. For almost 10 years, Eurozone policy making focused on two main macroeconomic goals: the ECB's monetary policy credibility and the inflation target, seen as a broad success given low and stable inflation outcomes, and the Eurozone government's fiscal responsibility, seen as a failure given the general disregard for the SGP rules. However, policymakers failed to spot key microeconomics and financial developments that were to plunge the Eurozone into crisis in 2008 and beyond. We focus on two questions. First, causes and consequences of an asymmetrical crisis. Second, the policy-making context. First, boom and bust, causes and consequences of an asymmetrical crisis. With a fanatical devotion to inflation targeting, the ECB paid insufficient attention to what was historically a primary responsibility of central banks, namely financial stability. Within some parts of the Eurozone, borrowers in the private sector were engaged in a credit-fueled boom. In other parts of the Eurozone, savers and banks funneled ever more loans toward those borrowers. The creditors were called Northern European countries like Germany and the Netherlands. The debtors were fast-growing peripheral nations such as Greece, Ireland, Portugal, and Spain. In Greece, much of the borrowing was by a fiscally irresponsible government that was later found to be falsifying its accounts. In the other peripheral nations, however, the flow of loans funded rapid investment and consumption surges, including a residential construction boom that in places, for example, Dublin. In Ireland and Spain, even as this boom took place, the government had maintained a fiscal position close to balance or even surplus. The asymmetrical boom helped them at that time. The trouble was to come when the boom gave way to severe asymmetrical bust. Growth slowed sharply when the global boom turned to a bust that dragged Europe down with it. Much of the construction and overconsumption in the peripheral economies turned out to be unjustified and unsustainable. Along the way, however, the boom had bid up the prices of assets, notably houses, and of many non-traded services, and thus wages, and had left householders in the peripheral nations saddled with high debts and uncompetitive. High wage levels that could not be sustained once the artificially high demand of the boom years was exhausted. These events were bad enough, but other factors made things worse. A vicious spiral began in the peripherals. Construction and non-traded sectors started to collapse, which lowered demand. House prices fell, as did the value of firms. Wealth collapsed, lowering demand further. Output fell in the short run, as did tax revenues. Households cut spending further. and the governments also tightened their belts. With everyone suffering lower incomes and wealth, and the economy contracting, bankers tightened lending, which hurt demand even more. As the spiral continued, banks found that their loans were often turning bad, and that many deaths would be rapid, only partial, if at all, because much of the peripheral lending came from banks connected to the Northern European core. These developments triggered tighter credit everywhere in the Eurozone as banks turned cautious. Lending growth for the whole Eurozone was virtually frozen for 5 years. Second, the policy-making context. The Eurozone faced a hard choice after the crisis hit in 2008, but the policy measures taken were more timid and quickly reversed as compared with actions in other countries. Why? The choice made can potentially be explained by considering the unique features of the European Monetary Union. We highlight 6 points. 1 is limited lender of last resort. The Eurozone is a monetary union and has a common central bank, but the ECB is highly inflation averse, is restricted from direct government finance, and is required not to engage in lend of last resort action to banks lacking good character. It is therefore unwilling to intervene with emergency liquidity in weak local banks, except with stricter guarantees from the local sovereign government, and it has been generally unwilling, with some exceptions, to intervene to ensure weak sovereign remain funded at sustainable interest rates. 2 is no fiscal union. The Eurozone lacks a political fiscal union and has no fiscal policy tools because there is no central budget that can be used to engage in cross-country stabilization of shocks. This is in large part due to the absence of a central European government, executive power standing above the sovereigns, the member states. In contrast, in the United States, with a strong central sustainable federal level automatic transfers between states act as a significant buffer. In fact, the Eurozone has a reverse problem. When the national sovereigns lose credit market access on reasonable terms, they must beg for assistance from the EU, ECB, and the International Monetary Fund, IMF, the so-called Troika. As a condition for granting assistance, these organizations have imposed harsher terms that require the countries to undertake physical contractions during their slumps, amplifying their business cycles. Overall, even for countries not in a rescue program, the EU authorities have sought even stricter fiscal rules and monitoring since the crisis, adding stringent new rules for all countries in addition to the Maastricht and SGB protocols. 3 is no banking union. The Eurozone also lacks even the minimal political fiscal cooperation to create a banking union, meaning that responsibility for supervision banks and resolving or rescuing them when they are in insolvent, rests with national surveillance. In the United States, in contrast, the Federal Deposit Insurance Corporation and other institutions underpin a true federal-level banking union with a common pool of fiscal and monetary resources. Theoretically, the insurance of an individual U.S. state's banking system does not depend at all on the fiscal position of the state itself. Despite the EU claims to have established a banking union in recent years, the actual structure is inadequate. The supervising and the regulation of banks is run out of Frankfurt, but no common pool of fiscal resources at the Eurozone level has been created to the supervision and the regulation of banks is run out of Frankfurt, but no common pool of fiscal resources at the Eurozone level has been created to back deposit insurance. Instead, from 2016, the first loss in the case of bank losses falls on built-in equity holders, bondholders, and the large depositors of the institution. Any further loss then falls on the member state itself. There is no cross-country pooling of risk, mainly because strong countries understandably do not want to share risk with weak countries. But this unwillingness to create cross-country insurance in turn leads to a deeper problem, the doom loop. 4 is sovereign bank doom loop. Because there isn't banking union or political fiscal union, a Eurozone country's national banks tend to hold the local national sovereign debt. But in return, this sovereign can end up bearing large fiscal costs to repair banking systems and protect depositors from losing their money under the current rules just described. The banks and the sovereign can then enter into a so-called doom loop. Weak banks' losses can damage the sovereign's creditworthiness just when it may need funds to resolve a crisis. Simultaneously, a weak sovereign debt can decline in value, damaging the balance sheets of local banks, while such local debt is predominantly held. In contrast, there is no local U.S. doom loop. An Illinois bank doesn't hold Illinois debt, so an Illinois default would not hurt Illinois banks, and an Illinois bank failure is handled by the federal authorities and would not burden the state of Illinois itself. 5 is labor immobility. Because the Eurozone is especially weak on labor mobility, a local economic slump is likely to be persistent for longer because unemployed workers cannot migrate easily to another country where there are better opportunities. After the crisis, local long-term unemployment rates rose to very high levels in some countries, despite strong economic conditions in the core Eurozone countries. The United States saw more labor migration between asymmetrical affected areas in its slum. 6 is exit risk. We know that after bearing more than a decade, the credibility of the Eurozone as permanent with no possibility of exit, is not 100% certain. Events have shown that the risk of a country exit can put financial pressure on that country. If investors suspect that a country will exit the Eurozone, they will want to pull their money out of the country's banks and sell its debt to avoid potential losses. The result is capital flight to safe havens and higher risk problems on local interest rates. The result is capital flight to safe havens and higher risk premiums on local interest rates. This reflects the non-zero redenomination risk of local assets out of euros and into a new and much depreciated local currency, plus the risk of losses depositors while bank restructuring. This dynamic was much in evidence in Cyprus in 2013, for example. That's all for today. See you next time.